Oil is back down 5% this morning on China growth fears. The RBA tones down the hawkishness in its September board minutes, and all eyes are on the Reserve Bank of New Zealand's rate decision today. Will it be 25 or 50 basis points? That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung explains why a stimulus briefing by Chinese authorities yesterday didn't include any additional stimulus.
Overall, I still feel this meeting is still very important, even though it's lacked the intensity, and that may disappoint the market.
But first, in 5 and 5 with ANZ. I'm Alex Tarrant, standing in for Bernard Hickey, who's on family leave. Oil prices were down over 5% this morning, with Brent back at $76.4 a barrel at 4 a.m. Sydney-Melbourne time. That followed disappointment over a stimulus briefing held by Chinese authorities, which contained no new measures. More on that in our deep dive. In the US, the S&P 500 was up 0.8%, as several Fed members suggested a soft economic landing was still in their sights. Today, all eyes are on the Reserve Bank of New Zealand's rate decision. ANZ New Zealand Chief Economist Sharon Zollner and the market are expecting a 50 basis point cut to 4.75%. But Sharon says a lot will come down to the Reserve Bank's confidence in its inflation forecasts.
If you're really feeling your way, then that does speak to 25 basis point cuts rather than going fast. So we are not as confident as the market seems to be, or some economists, that a 50 basis point cut is not only a given but a no-brainer, because, well, basically we're seeing that the economy could actually respond to these rate cuts quite vigorously.
The New Zealand dollar was trading flat at 61.22 US cents at 4 a.m. Sydney-Melbourne time, ahead of the decision this afternoon, while the Aussie was down 0.26% at 67.40 US cents. Number 2. The Reserve Bank of Australia's September board minutes contained 2 clear signals of a step down in recent hawkishness. ANZ head of Australian economics Adam Boyton says. Adam says the first point was that the board didn't explicitly consider a rate hike at the meeting.
The second point is this line where, quote, members noted that each of these outcomes was conceivable given the considerable uncertainty around the economic outlook. Therefore, future financial conditions might need to be either tighter or looser than at present. So that the bank or the board are talking about tighter or looser, I think is a bit of a change from the dynamics we've had in recent meetings where the board has explicitly considered a rate hike and has decided not to. This was more a consideration of a range of scenarios.
Number 3. Adam still expects the RBA won't lower rates until February 2025, with the minutes indicating the board believes that just because others are on the move doesn't mean they have to be.
The key point there is that, yes, the Reserve Bank's looking at that, but the conclusion and the point that I think people should take away here is just because central banks overseas are doing anything doesn't automatically mean the Reserve Bank of Australia needs to do that. And the Reserve Bank sort of made the point that, economic conditions and policy settings in Australia are a little different to those overseas, which means we don't automatically need to follow what's occurring overseas.
Number 4. ANZ Roy Morgan consumer confidence ticked up 1.5 points last week to 83.5, led by views on current financial conditions. But as ANZ economist Maddie Dunk explains, the survey just can't seem to crack out of a tight range below 85, let alone get close to the neutral 100 mark.
Yeah, we've had this 85-point mark that we just haven't been able to crack for consumer confidence. And every time we look close to getting there, we just seem to pull away. And I think that the signs are that we will surpass 85 points, but it's going to be a slow grind upwards. And when you look at the trend in the ANZ Roy Morgan consumer confidence chart, you can see that it's inching upwards, but very, very slowly.
Number 5. One potential confidence booster is the strength of Australia's jobs market. ANZ Indeed job ads rose 1.6% in September, the first increase in 8 months. Maddie says this and other improving data will be catching the RBA's attention.
They'd also be looking at the NAB business survey with an eye of caution, because what we're seeing is these broad-based signs of strength in forward indicators. So the soft data, such as the NAB business survey, for example, is back up, and we're seeing conditions are around their long-run average again. ANZ Indeed job ads has picked up in the last month, and you couple that with the resilience in the labour market, it points to quite a bit more staying power than what the RBA was probably expecting.
Maddie Dunk there. Now, in our bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung says while new stimulus was not announced in a briefing by China's National Development and Reform Commission yesterday, the signals indicate some fiscal support is on its way.
The markets had a high hope of any new stimulus that will also be launching following the central bank's easing 2 weeks ago and the stock market crazily rally in the last 2 weeks, and the financial market has been trying to see any new surprise that will be launched by the policymaker. So that's why the market has been so focused on the briefing today. Overall, the NDRC did not give any new stimulus. They reiterate that China will continue to try the best to achieve this year economic target, namely 5% growth, and the expansionary policy will include a package of policy covering property support, consumption support, quickening the government spending, and also try the best to achieve the target under the 14th five-year plan that would include many infrastructure project developments. So that's the whole purpose of today's NDRC meeting.
What were people hoping for?
I believe the market has been very excited about the surprise delivered by the central banks and the financial regulators, especially with the direct support or the funding support to reactivate the security and the stock market. And obviously, the market was also hoping the Chinese government will complement the monetary injection with strong fiscal policy. But so far, the NDRC's briefing did not mention specifically the amount and quantity of fiscal expansion. For example, we are expecting that the Ministry of Finance will adjust the fiscal deficit or to increase the fiscal deficit a bit, but that's also require the approval from the National People's Congress that will be holding a meeting, or the Standing Committee will hold a meeting later this month to approve such amount. So far, this NDRC briefing did not unveil or talks about how much the supplementary budget will be and what will be included in the budget, and also how much additional government bonds will be issued, but that will be the direction to go. Now, overall, I still feel this meeting is still very important, even though it's lacked the intensity and that may disappoint the market, but it is so important that the NDRC follow up from the State Council Standing Committee meetings before the holiday and reiterate the point that the Chinese government is confident that they will achieve the 5% growth target this year.
Does this put a lid on where China stocks might go?
Now, obviously, the market's been hoping the NDRC press briefing will provide some new stimulus. We didn't expect that. We knew that the NDRC is a planner, as a coordinator to coordinate different policies by different ministries, and to be very specific, they need the Ministry of Finance and Ministry of Commerce and many other ministries to come up with specific measures. So this is just a package of policy items, but obviously by reiterating that what they will do has already disappointed the market, who is looking for some specific measure in quantitative terms. So it's a sort of market correction because, the onshore market was closed last week, and this is just the first day the onshore market opened, but the offshore market in Hong Kong has already been trading for several days with a very strong performance. So I won't be surprised that this type of reaction happened in the equities market, and even be some profit taking for investors to reposition how they should look at the onshore and the offshore market. Now, of course, that would also be some spillover effect to other asset classes, iron ore and commodity price as well.
Raymond Yeung there. I'm Alex Tarrant, standing in for Bernard Hickey, who's away today on family leave. That was 5 and 5 with ANZ for Wednesday, October the 9th. Catch you tomorrow with reviews of rate decisions by the Reserve Bank of India and the Reserve Bank of New Zealand.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.